Credit is the trust which allows one party to provide money or resources to another party wherein the second party does not reimburse the first party immediately, thereby generating a debt, but promises either to repay or return those resources, or other materials of equal value, at a later date. The resources provided by the first party can be either property, fulfillment of promises, or performances. In other words, credit is a method of making reciprocity formal, legally enforceable, and extensible to a large group of unrelated people. The resources provided may be financial, e.g. granting a loan, or they may consist of goods or services, e.g. consumer credit. Credit encompasses any form of deferred payment. Credit is extended by a creditor, also known as a lender, to a debtor, also known as a borrower. In the 19th century, general stores in agrarian communities would keep ledgers of store credit. Farmers would buy on credit during the year and pay back their debts at harvest time after selling their crops. Credit cards became most prominent during the 1900s. Larger companies began creating chains with other companies and used a credit card as a way to make payments to any of these companies. The companies charged the cardholder a certain annual fee and chose their billing methods, while each participating company was charged a percentage of total billings. This led to the creating of credit cards on behalf of banks around the world. Some other first bank-issued credit cards include Bank of America's Bank Amer Icard in 1958 and American Express card also in 1958. These work similarly to the company-issued credit cards. However, they expanded purchasing power to almost any service and they allowed a consumer to accumulate revolving credit. Revolving credit was a means to pay off a balance at a later date while incurring a finance charge for the balance. Discrimination. Until the Equal Credit Opportunity Act in 1974, women in America were given credit cards under stricter terms, or not at all. It could be hard for a woman to buy a house without a male cosigner. 7. In the past, even when not explicitly barred from them, people of color were often unable to get credit to buy a house in white neighborhoods. Bank-issued credit. Bank-issued credit makes up the largest proportion of credit in existence. The traditional view of banks as intermediaries between savers and borrowers is incorrect. Modern banking is about credit creation. Credit is made up of two parts: the credit, money, and its corresponding debt, which requires repayment with interest. The majority, 97% as of December 2013, of the money in the UK economy is created as credit. When a bank issues credit, i.e. makes a loan, it writes a negative entry into the liabilities column of its balance sheet, and an equivalent positive figure on the assets column, the asset being the loan repayment income stream, plus interest, from a credit-worthy individual. When the debt is fully repaid, the credit and debt are cancelled, and the money disappears from the economy. Meanwhile, the debtor receives a positive cash balance, which is used to purchase something like a house, but also an equivalent negative liability to be repaid to the bank over the duration. Most of the credit created goes into the purchase of land and property, creating inflation in those markets, which is a major driver of the economic cycle. There are two main forms of private credit created by banks: unsecured, non-collateralized credit such as consumer credit cards and small unsecured loans, and secured, collateralized credit, typically secured against the item being purchased with the money, house, boat, car, etc. To reduce their exposure to the risk of not getting their money back, credit default, banks will tend to issue large credit sums to those deemed credit-worthy, and also to require collateral, something of equivalent value to the loan, which will be passed to the bank if the debtor fails to meet the repayment terms of the loan. In this instance, the bank uses the sale of the collateral to reduce its liabilities. Examples of secured credit include consumer mortgages used to buy houses, boats, etc., and PCP, personal contract plan, credit agreements for automobile purchases. Movements of financial capital are normally dependent on either credit or equity transfers. The global credit market is 3 times the size of global equity. Credit is in turn dependent on the reputation or creditworthiness of the entity which takes responsibility for the funds. The purest form is the credit default swap market, which is essentially a traded market in credit insurance. A credit default swap represents the price at which two parties exchange this risk. The protection seller takes the risk of default of the credit in return for a payment, commonly denoted in basis points. 1 basis point is 1/100% of the notional amount to be referenced, while the protection buyer pays this premium and in the case of default of the underlying, a loan, bond, or other receivable, delivers this receivable to the protection seller and receives from the seller the par amount, that is made whole. Types. There are many types of credit, including but not limited to bank credit, commerce, consumer credit, investment credit, international credit, and public credit. Trade credit. In commercial trade, the term trade credit refers to the approval of delayed payment for purchased goods. Credit is sometimes not granted to a buyer who has financial instability or difficulty. Companies frequently offer trade credit to their customers as part of terms of a purchase agreement. Organizations that offer credit to their customers frequently employ a credit manager. Consumer credit. Consumer credit can be defined as money, goods, or services provided to an individual in the absence of immediate payment. Common forms of consumer credit include credit cards, store cards, motor vehicle finance, personal loans, installment loans, consumer lines of credit, payday loans, retail installment loans, and mortgages. This is a broad definition of consumer credit and corresponds with the Bank of England's definition of lending to individuals. Given the size and nature of the mortgage market, many observers classify mortgage lending as a separate category of personal borrowing, and consequently, residential mortgages are excluded from some definitions of consumer credit, such as the one adopted by the U.S. Federal Reserve. The cost of credit is the additional amount, over and above the amount borrowed, that the borrower has to pay. It includes interest, arrangement fees, and any other charges. Some costs are mandatory, required by the lender as an integral part of the credit agreement. Other costs, such as those for credit insurance, may be optional. The borrower chooses whether or not they are included as part of the agreement. Interest and other charges are presented in a variety of different ways, but under many legislative regimes lenders are required to quote all mandatory charges in the form of an annual percentage rate, APR. The goal of the APR calculation is to promote truth in lending, to give potential borrowers a clear measure of the true cost of borrowing and to allow a comparison to be made between competing products. The APR is derived from the pattern of advances and repayments made during the agreement. Optional charges are usually not included in the APR calculation. Interest rates on loans to consumers, whether mortgages or credit cards, are most commonly determined with reference to a credit score. Calculated by private credit rating agencies or centralized credit bureaus based on factors such as prior defaults, payment history, and available credit, individuals with higher credit scores have access to lower APRs than those with lower scores. Credit is the ability to borrow money under the agreement that you'll repay the debt later. Credit agreements typically come with repayment terms that include when payments will be due, plus any interest and fees you'll need to pay. Credit can also refer to an individual's history of borrowing and repaying debt. Credit is a financial term that has a couple different definitions. One definition of credit is the ability to borrow money and repay the balance you owe over time. A credit agreement typically includes interest that a person has to pay in exchange for the ability to borrow. Another definition of credit is an assessment of an individual's borrowing history. In this context, having good credit means that you have a history of responsibly borrowing and repaying debts. On the other hand, having poor credit may mean that you don't have much established borrowing history or that you have some negative information in your credit history. Credit is also the creditworthiness or credit history of an individual or a company. Good credit tells lenders you have a history of reliably repaying what you owe on loans. Establishing good credit is essential to getting the approved for loans like mortgages and getting the best interest rates on them. In the world of accounting, credit refers to a specific type of bookkeeping entry. Credit typically is defined as an agreement between a lender and a borrower. Credit also can refer to an individual's or a business's creditworthiness. In accounting, a credit is a bookkeeping entry, the opposite of which is a debit. Credit is an agreement between a creditor, lender, and a borrower, debtor. The debtor promises to repay the lender, often with interest, or risk financial or legal penalties. There are many different forms of credit. Common examples include car loans, mortgages, personal loans, and lines of credit. Essentially, when the bank or other financial institution makes a loan, it credits money to the borrower, who must pay it back at a future date. Credit cards are an example of credit that allowing you to purchase just about anything on credit. The card issuing bank serves as an intermediary between buyer and seller, paying the seller in full while extending credit to the buyer, who may repay the debt over time while incurring interest charges until it is fully paid off. Similarly, if buyers receive products or services from a seller who doesn't require payment until later, that is a form of credit. For example, when a restaurant receives a truckload of produce from a wholesaler who will bill the restaurant for it a month later, the wholesaler is providing the restaurant owner with a form of credit. Credit is also used as shorthand to describe the financial soundness of businesses or individuals. Someone who has good or excellent credit is considered less of a risk to lenders than someone with bad or poor credit. The word credit has multiple meanings in personal and business finance. Most often it refers to the ability to buy a good or service and pay for it at some future point. Credit may be arranged directly between a buyer and seller or with the assistance of an intermediary, such as a bank or other financial institution. Credit serves a vital purpose in making the world of commerce run smoothly. Credit, transaction between two parties in which one, the creditor or lender, supplies money, goods, services, or securities in return for a promised future payment by the other, the debtor or borrower. Such transactions normally include the payment of interest to the lender. Credit may be extended by public or private institutions to finance business activities, agricultural operations, consumer expenditures, or government projects. Most modern credit is extended through specialized financial institutions, of which commercial banks are the oldest and most important. In present-day industrial economies, the banks are able to extend and increase the supply of credit by the creation of new deposits for their loan customers. The lender must judge each loan he makes on the basis of the character of the borrower, his intention to repay, his capacity to repay, based on his potential for earning income, and his collateral, property pledged in case of default on the loan. The terms of credit transactions may be publicly regulated to prevent abuses by customers and lenders as well as to channel credit into particular sectors of the economy. In fields for which adequate private financing is not available, governments may extend credit. Public lending programs, often combined with public systems of savings collection, provide a large portion of housing finance in many European and Asian countries. In the US, public credit is frequently extended for housing, small business, and agriculture. Commercial banks in both industrialized and less developed countries are often reluctant to extend agricultural credit because of the high risk involved. Such loans are usually made only to very large farms. In addition to government credit, cooperative credit systems have been particularly important in less developed countries, where they are often the only source of funds available to small farmers at reasonable rates of interest. Thank you for watching this video.